you have an income statement and another comparative balance sheet. And you also have some additional information here, okay? There's like there's a investment that was made 100% with a long-term note payable. So this is going to kind of be a note, right? Because it's not going to appear on the statement of cash flow because there's no cash that's transacted, even though it was an investing and a financing activity. Um, so you'll have to just kind of read through the financial statements, read through this additional information, and now you're going to do the full thing. Okay, you're going to start with the operating section. You're going to do the investing section. You're going to do the financing section, and you should be able to reconcile how cash went from 15,600 to 26,700. Okay, that's how you'll know that you did each of those three sections correctly, and that the net change in cash should reconcile this first line here. Again, for the operating section, you have the add backs. Okay, so again, I would go back to this slide. This is kind of giving you the outline. Okay, start with net income. Add back depreciation, depletion, and amortization expense. Add back or subtract any gains or losses from the disposal of any assets. And then you'll have to do these adjustments for how the current assets and current liabilities accounts changed. And that will give you your cash flow from operations. Okay, so this is a step-by-step guide. Start with net income, do these adjustments, and you'll get your cash from operations. So this is definitely the hardest section, the operating section. Okay, so but yeah, now it's time for you guys to be pushed out of the nest and see if you can figure it out. Okay, see if you can fly. So try to do it yourselves, and of course we'll do it together later. Okay, so again, we start with net income, and we are going to adjust net income because again, there's a mix of cash and non-cash things going on in net income. So net income is from this income statement, 99,500. The first and obvious add back is depreciation expense. We know for a fact depreciation expense is fully non-cash because the journal entry is debit depreciation expense, credit accumulated depreciation. There's no cash involved with that. So this is a pure non-cash expense that we know reduced net income, but not because of a cash flow, because it's a accrual expense. It's a accrual based accounting expense. Okay, so now it didn't mention any gain or loss on the sale of an asset. Yeah, so it says a plant asset was disposed of for $0. During the year, there were no sales of land, no retirement stock, no treasury stock transactions. A plant asset was disposed of for $0. There was a disposal, but the book value was what of that disposed asset? Zero. Okay, the cost and accumulated depreciation of the disposed asset was $12,060. So though we got $0 for it, it was already on our balance sheet for zero. So there was no gain or loss. Okay, is everyone good with that? So we don't have to do that adjustment because is neither a gain nor a loss. It's like break even. We had it on our balance sheet for zero, and we got rid of it for zero. Okay. So now we'll turn to the changes in our current assets and current liabilities. Okay, so we can see here accounts receivable went up from 25,300 to 26,500. So that's an increase of $1,200. So this is increase in accounts receivable. Now, is that going to be an increase or decrease in cash flow? It's a decrease, right? We had accounts receivable 26,500, and the beginning balance was 25,300. So we had revenue of 23,800. let's just assume that it was all credit sales. Okay. So we would have had an increase. So let's assume all of the revenue, 238,000 was, sorry, this is totally wrong. These are debits. So 25, 300, 26, 500. So if all of our sales revenue was accounts receivable, it would have been 438,000. Okay. So what do we need? This is the amount of cash that we collected. What is this going to be? How should we calculate it? Is it going to be more or less than this? It's going to be less, exactly. Okay, so that's why it's a negative adjustment. That's what I'm trying to illustrate here. Okay, so um, so this $1,200 is kind of it comes from this in that we needed to have this 200 438,000 is how much was showing on the income statement, but really the amount of cash we collected was $1,200 less than that. Okay, whatever, it's 420, whatever it is. Okay, you can do the math, but it's $1,200 less than this. Okay, so again, we're trying to adjust net income, which includes this full $438,000 for how much cash flow came in. And we just saw with the T account that it wasn't a full 438,000 of cash that came in. It was slightly less than that. So that's why this is a negative adjustment. Okay. We'll do the same thing for inventory. Okay, so we see that we have a decrease in inventory of, I'll just do the math here, 91,900 minus 79,900. So again, this is an increase, or sorry, decrease in a merchandise inventory. And so that is going to kind of be the opposite of this. They're both current assets. A increase in accounts receivable is a negative adjustment. A decrease in inventory is a positive adjustment. And you can just think about it like this. We have some inventory at the start of the year. We sold all of this cost of goods sold, 209,200, plus an extra 12,000 that we did not kind of replenish. So that's this extra cash flow. Okay. So um, it's like you're liquidating your inventory, right? If we had not changed, if we had no change in merchandise inventory, then um, we basically could have just used cost of goods sold as a like that's like how much cash of inventory kind of left the door. But since we sold an extra amount beyond what we started with, that's kind of extra cash flow. It's cash that we didn't spend to buy more inventory. So that's why it's a positive adjustment. Okay. Okay, and then so now let's do the current liabilities. So we have for accounts payable 35,600 minus 30,500. I'm getting that from the balance sheet here. So this is an increase in accounts payable. You can think of that increase as like extra money you've borrowed. So this is going to be a positive adjustment too. And then accrued liabilities. This is kind of like unearned revenue. You can think about it like that. And this is a decrease. So it's going to be a negative adjustment. Okay. So again, we started with net income, and now we've adjusted for all the non-cash kind of, or the non-cash expense here, depreciation expense, and then these changes in our current assets and liabilities representing kind of how much cash was either fronted in the case of like accrued liabilities, or we kind of sold on credit and we haven't collected the cash yet. Okay, so now let's just make sure this all ties together. I'm just going to add up all this stuff. And yes, we got to the right answer. Okay, all right, so now we're doing the investing section. Cash flow, investing cash flow, we'll call it. Okay, so you're going to have acquisition of assets and then disposal of assets. Okay, so um, I've just recreated this based on the comparative balance sheet, these three accounts. Now, we have to use some of the information. Okay, so it told us that land purchase 24,500 by financing with 100% long-term notes payable. So we added 24,500 here. So this ties, okay? We don't have to include this in the cash flow section because it was financed with the notes payable. But at least this land account, we can see that there's no other additional land purchases because it is fully accounted by this uh, non-cash investment in land. Okay, so now we can just turn to these two. We were told that there was one disposition. The cost and accumulated depreciation of the disposed asset was $12,060. So I know that there was a credit of 12,060 here and also a debit of 12,060 here. Okay, so now we're going to have to figure out how much was acquired. Because if we just did this minus this, we don't get to this ending balance. The math would give us 26,700. So now if you do the math, you should be able to do this plus this minus this gives you this. And so basically this is the only thing in investing section. Okay, because we got $0 from that disposition. We just got rid of it. So there is no cash flow coming in from the disposal of assets. We just have really this cash flow of acquisitions. Okay, so we really only have one entry. So disposal, $0 came in, but 26,700 went out in acquisitions. So our total net cash flow from investing activities is just equal to this. Okay, so financing, um, it's going to include dividends. It's going to include any stock that was issued. If there's any new long-term notes payable, that was, again, there's one addition to long-term notes payable from that acquisition of land. So that's not going to be in here because, again, that was a non-cash investing and financing activity. But maybe there's more. You have to do the math to see if that 24,500 increase in notes payable, if there's any more or anything else that happened in notes payable. So you have to look at that. So the issuance of common stock, we can just get from looking at our equity section. It told us that there's no treasury stock transactions, so we can just look at the beginning and ending balance. We see that there's an increase, so we can see that we've issued common stock, and we can just figure out the amount by just taking the difference. So this is equal to 88,200 minus 64,300. Okay. Now notes payable, we have a net decrease. Okay, so we had one transaction that we know increased notes payable by 24,500. We see that we had an overall decrease. So something happened. Okay, so let's look at the T account for notes payable. So we have notes payable. The ending balance, I think, was 77,000. And the starting balance was 103,000. And we know that there is an increase in notes payable by 24,500 from that purchase of land. This is from the land purchase. Okay, so now we have to basically solve for this missing debit, which is a payment of notes payable, 50,500. Okay, so you should be able to do this plus this minus 50,500 is 77,000. This was a decrease in cash. We're paying off 50,500 worth of notes payable. And now the dividends. So we have basically the T account for retained earnings. Okay, so we started off with 6,100. And again, I'm getting this from the balance sheet here. 6,100 here. We ended with 41,800. We had net income of 99,500. Okay, so we have to solve for the missing dividend, 63,800. So now we can go back to this. We know the dividend is also a negative cash flow. And so now when we add all of this up, okay, so now we've finished all three sections. We can get our net change in cash, which is just equal to each of the sections totals. And once I populate this formula is now taking into account the net change. And we can see that it exactly reconciles with our cash ending balance of 26,700. So I just took the starting balance of cash, saw what the change in cash was, and it gives me the exact ending balance that's tied to our balance sheet. This is like the net, and then this is, if you read down here, cash at the beginning of the period, and then you get to the ending. And if we look here, so let's just prove this. 5488 is the ending balance. So if we look on the balance sheet, we can see 5488.